Good morning. This is Tom Alexander. It is Saturday, May 10th. This is my weekly stock market update. And I'll begin with saying there is virtually everything that I'm going to say today is a repeat of what I said last weekend because all the indices, as you will see in just a minute, are virtually unchanged from a week ago. We have had this furious ramp up in the U.S. indices off that spike low in early April. And now what we've done is digest that move by going sideways. So we're in sort of Groundhog Day on a day-to-day basis with no net change, waiting on the next utterance from some power that be about trade. That seems to be the exogenous event that the indices are tethered to at the moment. But we are at very interesting levels in the indices. So let's take a look at the charts. And we'll just go through one by one. Now, real quickly, if you want to download a PDF of the charts that I'm about to show, if you want to take a look at them on the website, you can go to alexandertrading.com, click on weekly update right here, and you will get the report for today. You'll see all the charts. There's a PDF you can download. You can also go back a couple of years and look at the what I said that week for the previous week. This is free. Again, you just click on weekly update and it will bring you here. Then you can click on the report for Monday and you'll get all the information basically that I'm going to go through with you now. So, okay, let's start with the SPX. The SPX had a net change. It was down less than half of 1% last week. Now, intraday, it was a air pocket chop fest as the market tried to digest every single utterance from a government official about trade. And that's where we are now. From an auction market perspective, a price action perspective, you can see we are bumping up against a really critical intermediate term level that includes the 200-day moving average. It includes the peak back in late March. So this is a very important technical level. Everybody and their brother knows this. This is a major inflection point. If we get through this level on expanding breadth and momentum, it's very likely we will trade to new all-time highs. That's a big if. Now, to the downside, last week's low is going to be important. That's your immediate downside level to keep an eye on as we head into the next week. And that's true with all the indices. I'm going to go through each of them, but this is the SPX. And then let's go to the NDX. The SPX and NDX, not surprisingly, are pretty much in lockstep with one another. The NDX is actually a little bit deeper into that critical key reference area, or it reached deeper into it. It closed down 0.2% week over week. So it again, the indices went net nowhere last week, but you can see the NDX traded into that very critical key reference area to the upside. That is a major inflection point, and from where you're expecting a very sharp move to occur sooner rather than later. Okay, let's take a look at the Dow. Now the Dow is lagging a little bit in terms of the similar level as the SPX and NDX. You can see it's the 200-day moving average is up here, and then that March high is up here. So it has a ways to go. And what we're seeing here is a structural divergence among some of the major indices. In bull trends, what you're looking for, actually in bull trends or bear trends, a larger degree trends, you're looking for things to pretty much be in lockstep. Now, one will lag for a while, then another may lag for a while as you have this reallocation of assets depending on a large cap, small cap, and what big money wants to do. But generally in bull trends, in healthy bull trends, you have everything pretty much making higher highs and higher lows within the same relative time frame, not necessarily the same day and not necessarily the same week, but eventually. And we haven't had that for a long time. So that's a intermediate to long-term heads up about the condition of the U.S. indices as a whole. So you can see the Dow is lagging a little bit. Let's move over to the Russell. Speaking of lagging, where are you, Russell? And you can see the Russell is, I mean, it's so far from an all-time high. I don't even have it up here. It was up about 0.12% last week. Now, an index, the equal weight S&P, this is actually an ETF that is an equal weight as opposed to cap weighted index, as is the SPX, an index, and it is showing a lot of relative strength. It is also, however, just below a major level here, a major inflection point. And then the broadest index is the New York Composite, and it is less than 5% from a new all-time high. So we have this disparity, this structural disparity that continues to grow among and between the indices. Now, last week, I felt very strongly. One thing I said was the market may go up, but it's not going to go up at this rate of change. Well, that certainly occurred. Now, markets can correct by time through time. Something Stoudemire said was time over price equals value. So what we did not see last week was a strong downside reaction, or we haven't seen that yet. Now it may occur, but the reality is it goes on the bullish side of the ledger that the market has held up for the past week because we had just an extraordinary ramp into Friday week ago's close, and then the market basically had very minor retracement and closed within striking distance of that same level. So that could be, you can make a bullish case there. However, we still have to get above these inflection points that are in which the indices are trading in at the moment or are just below to get overly excited about prospects. And it's hard for me to visualize how that structure is going to look if we don't get any more downside retracement than we've had prior to taking out these upper levels. That would set up some extremes from a technical perspective that would be pretty historic. But I mean, it's that type of market. Okay, speaking of extremes and technicals, let's take a look. VIX continues to drop. It's still above 20. There is no big tell here from a market perspective about, it's just not at an extreme. One thing that, this will be Captain Obvious, but if the market continues higher, VIX is going to drop. And if the market decides to drop here, VIX is going to increase. But looking at this is not helpful in weighting the direction. Okay, let's take a look at in breadth that I use a lot, and the 10-day and 5-day moving averages are diverging against recent highs. That's not a big surprise because we went net sideways, and these are moving averages. Moving averages of 10-day NYSE advancing issues. The red's 10-day, green is 5-day. What you see down here, the histogram is breadth. It's NYSE closing breadth. Now, something to make note of in breadth is it's been in a super narrow range really since the 24th of April. So for the past 2 trading weeks, breadth has been rather neutral in a very narrow range. And I think that's reflecting the uncertainty of market participants in whether or not to sell or buy this thing to go all in. So that's where we are as we head into next week. You guys have a wonderful weekend. If you found value in this, please like, please subscribe. I will talk with you again very soon.